What's up? What's up? Welcome back. This is Desmond, investor, agent, rehabber, wholesaler, you name it, all above. We've done those investment strategies. So today here we want to talk about funding deals. What are some of the top ways and how to get your deals funded? I have a lot of people that reach out to me and they're scared to start, they're scared to do something, they're scared of putting something under contract with fear of how is this deal going to get funded. Now, assuming that we're not going to be wholesaling it ourselves, people are thinking that they need to go and get, line up all this kind of money or save up $100,000 before they can go and buy a property. That is not the case. So I'm going to talk about how I did it, how I got deals funded with no money or close to no money, especially when even flips, even development deals, all these other different types of deals. So we're going to talk about how to get deals funded. So what are we going to talk about specifically? So we are going to cover, got our handy dandy investment iPad right here in front of us. So we're going to cover, hard money. What is hard money? How does it work? How do we use it? We're going to cover private money. What is private money? How does it work? How do we use it? What else are we going to cover? We're going to cover some traditional loan types. So traditional loans. And when I'm talking about traditional loans, I'm meaning loans that you can get from most mortgage brokers. Now, specifically the loans that they have, are going to be some portfolio loans like the DSCR loan. So we're going to talk about that and how we can get those deals funded. Um, Really, we're going to touch on a little bit of some creative as well. We're going to touch on a little bit of creative. This isn't going to be a deep dive into creative, how you can get deals funded creatively, but we're going to touch on it. And a little bonus to this video as well, I'm going to talk to you about how I've actually combined these strategies to get deals funded to where I've done flips and personal investments, etc., to where I had $0 out of pocket. So that's where it really starts to become cool. So when you start putting these things together. So let's jump on first. Let's go into hard money. Hard money. Sweet. So most people, if you're probably here, you probably at least have some sort of a baseline idea about hard money. When you think of hard money, you think of interest only. You think of short term. You think of, points. Points that sometimes you need to pay, or most of the times you need to pay. You think of high interest rates. And you would be correct in thinking all of that stuff when it comes to hard money. So hard money loans are typically short loans that we're using for rehabbing a property. Why are we using a hard money loan versus a conventional loan or anything else? Is because these properties won't be able to get approved through any type of a traditional bank loan or a traditional product. So we have to use hard money loans. Or maybe if you're in the case like me, in the situation like me, to where maybe you didn't have the credit to qualify for a traditional type of loan. Now, it's a good thing about hard money loans. They were typically based on the property, the income for the property, the ARV, after repair value of the property. That's how a lot of these lenders, and that's the scope that they would put these loans through when they're working with hard money. So if you were anything like me, I had to do these types of loans because when I first started flipping houses, I probably had close to a 550 credit score, and I was not able to qualify for any loan at that point in time in my life. But I didn't let that be a barrier to stopping me from doing these projects. So hard money. Let's talk about some typical terms when it comes to hard money. So I've seen hard money go anywhere from 9 to let's even say 12, 13%. That's going to be the rate. I've seen points that lenders will charge anywhere from 2 to 4 points. That could be a lot of factors: the loan, the lender, your experience, etc. I've even seen them some lower, or maybe even, well, I actually haven't seen any higher, but I've seen some lower as well. This is just kind of a range that you probably can expect to be within that rate. I've seen length, loan term, anywhere from like 6 to 12 months on average is where I've seen them for hard money loans. More times than not, they're usually 12-month loans. And that's kind of what you can expect with them. Now, you're using these again for projects that won't be able to qualify for another option, basically. Or if you're only using it for a short term for some sort of a bridge. For instance, let's say if I'm trying to borrow a property, I'm buying it, rehabbing it, renting it, refinancing, and repeat, I may use hard money for that initial purchase, that initial buy for that property. So I at least don't have to come out of pocket with my own money. This is assuming that you want to be leveraged in it. and only hold that loan for a short amount of time until I was able to do a cash out refinance on the back end to a traditional conventional loan or anything. But now, what a lot of people don't know about hard money loans or maybe don't realize is, there are other hard money loan products. So these things, for the most part, are true. But, there are hard money lenders that have the 30-year loans, 30-year rental loans that are amortized, or they even have longer term interest only loans. Interest only. Now, this may be for something that may be a larger development, something that's going to take a little bit of time, some new construction, etc. Where that 1 year time frame, this may be a project that's going to take, if it's a multi-unit development, this project may take more than a year. So there are even loans that go like that as well, that may be longer term, still interest only, or again, amortized loans that go 30 years. So hard money lenders, a lot of times they have all these products. The biggest thing that you want to know with hard money lenders is it's institutional. Institutional. And if I didn't spell that correctly, forgive me. Institutional. So that is where, that's where their money's coming from. Versus private money, let's talk about private money for a little bit. Private money can look just like hard money, but it's coming from the individual. So that's the biggest thing. It's going to be institutional versus individual. Now, the individual that's doing the private money, that can come from a lot of different places. It can come from somebody's, IRA. It can come from somebody's whole life policy, so long as it has a cash value. It can come from just somebody's bank account. Somebody just has cash sitting around. Stock accounts, etc. You get my drift here. There's so long as somebody has the net worth, there's probably a plethora of places that they can pull money on to be a private money lender for you versus institutional. Again, when you're thinking institutional, you're thinking up here, and they have certain rules that they need to abide by. For instance, a private money lender is willing to take a second position. A private money lender may be willing to do no payments. Private money lender may be able to go lower on interest rate or higher depending on the risk that they're looking for. And let's give an example here. So when I used to do flips, and still doing flips, we would pair a couple of different things. So my hard money lender, he would fund me 90% of purchase plus rehab. So I'll give you an example here. We'll put it out into numbers. Let's say that this is a $200,000 property. Sorry, there's one extra zero. Let's actually erase one of those. $200,000 property. And let's say that I was buying this property for $100K. So purchase $100K. And let's say this property needs $30K in rehab. And I was looking to achieve a $200,000 ARV. ARV is your after repair value. Cool. So all in all, I would need $130,000 for this property for me to be able to get this deal funded, for me to be able to fund this. Now my hard money lender, he'll give me 90% of that. So for numbers here, for numbers' sake, we're going to subtract $13,000, that's 10%, from this number, and my lender would give me $117K. $117,000. Did I do that math right? Yeah, I believe. Yes, I did do that math correctly. So $113,000 is what the lender, my hard money loan, would be. Now again, remember I told you that the private money lender up here, they're a lot more flexible with their terms. And so let's say I would go to Mr. Private money lender, that maybe they had $20,000, $30,000 sitting in their bank account that they, wasn't doing anything with it and deploy it and might as well get some money on it. And I would approach them and I would say, hey, but would you be willing to take a second position loan for, and remember, I still need to come up with 10% down. I need to come up with that, so it's $13K. So I'd approach that that private money lender, and I would say, hey, would you be willing to loan me $13,000? And typically in that form of money, that little bit of money, we may negotiate like a certain flat rate return, and I'll say like, hey, because again, there are no rules. You can make the rules whatever you want them to be. I would say, well, hey, if you loan me $13,000, I will give you 16. I'll give you $3,000 for your money. Whatever, $2,000 for your money. Which again, if you're looking at through the lens of $13,000, for them to get, let's even use $2,000. That's a 10, almost a 20% return. Somewhere probably around 18% return on their money that they're getting. Now, you can't just stick your money in the stock market and get that. Most certainly, you can't have it sitting in a savings account. Savings accounts right now are yielding at best, 4%. And that's if they're not even negative yielding. And when you take into consideration the inflation of that money's probably losing value over time. So it actually helps them to deploy that $13,000 into a project. So I'd go to them and they would say, yeah, I'd be willing to do that. I say, okay, great. Well, I'm going to give you this fantastic return, but here's what I'm going to ask for in return. I'm going to ask for no payments. Just, at closing when I'm done with the project, that you get that done. And I want to hold this, at a flat rate. I don't want any, accrued interest or anything else like that. And in exchange for that, you're going to get this fantastic return, call it 18%, but I also want you to take second position. And I would say, okay, great, that works. So then I got this other $13K from the private money lender. Now with that, I would take that and I'd be able to go do this project. And let's say this project was $130,000 for this example. Now I know there are fees and everything that happen in between, and I may borrow a little bit more from the private money lender, but just for the purpose of this example, this is how we're going to run it. $130,000. Boom. That's fantastic. And that's how I was able to do flips, again, with little to no money, and be able to jump into these projects. Now, and even if you don't have the private money lender for that extra 10% gap, let's just say you need to come up with 10% and just use the hard money lender. That's still a fantastic way to get your deals funded. So that goes over hard money and private money really quick. Now I'm going to talk about, and I'm not going to spend too much time on it, traditional loans. And this is going to be like your DSCR. For those of you who don't know, DSCR is your debt service coverage ratio loan. For instance, let's give an example here. These are loans that are based on income of the property. Income of property. Why is this important? Because if you're probably anything like me, and maybe an investor, maybe you don't want to show, claim as much, in tax. You want to write things off. To show income is sometimes tough for investors. It's the number one thing I saw with investors, when I was working as an agent with investors, and even myself as the investor, showing the income was probably one of the tougher gigs to be able to get these loans funded. So the fantastic thing about a DSCR loan, debt service coverage ratio loan, is that it goes off of the income of the property. That's what they're measuring. And let's say they have a 1.25, DSCR. What they mean by that is basically for every $1 that comes into the property, for every $1.25 that comes into the property, they're willing to loan you $1 on that mortgage. That mortgage payment has to be for $1 for every $1.25. Now again, I'm not going to go super in depth into that, but just know that they're using the income for the property, pro forma for the property, to estimate what your mortgage payment would be and what they would loan on it. So it's a really cool loan type as well. I think it's fantastic. We've done DSCR loans. Now, and then lastly here, you have creative. Now, I'm not going to go super in depth in this. In another video, I will go into more so in depth with seller finance and subject to. But these are basically two ways that you can get deals funded. One is, free and clear, or, there has to be equity here. This is equity. There has to be equity here. There has to be equity that you're able to get finance from the seller, where you are upgrading that seller to being the lender. Instead of you going to get a bank loan, that seller is becoming the bank for you, and they're using their equity. Instead of coming out and giving you $50,000 to buy the property, let's say, they're using their equity of $50,000 to finance you the property, and subject to, no equity. Or think that you're taking over a loan basically here. You're taking over a loan. Now, there's a difference between assumption of loan and just taking it over, which is a subject to. Not a video for that right here, right now, but that's essentially what's happening. But these are some of the best ways that I've personally funded deals, whether it's through traditional loans, private money loans, hard money loans, or creative finance. These are how I personally get my deals funded. Hope this is of help to you. If this was of any use to you, feel free to subscribe or not. We put out videos about, investing in real estate, especially from the agent's perspective. I believe there aren't enough people teaching us as the agents how we can do more investment deals or work with more investors, because all these ways work for getting your investors deals funded as well. So thanks again, and I'll see you guys in the next one.